now we're getting a little bit nosebleedy. I can't come in and buy now. And if anything, what you probably want to do if you are interested in something like a Litecoin is you want to probably throw in some stink bids. Look at that juicy tail down there. Ooh, that looks sexy down there. Throw in a stink bid. If you're lucky and there's some sort of big thump that comes right out of the gate, right? Maybe, oh, look at that, 88.6 right against there. Is there any lower? Oh, yeah, there is too. Cool. Yeah. So down in this area, sexy area, reload zone. I ever heard that Beamish guy talk about reload zones? So I kind of like that. I mean, try not to chase that. If we do sort of go sideways for a bit and put in 3 higher lows, and it's looking very W and your indicators are start pointing up, yeah, you might bought it. But frankly speaking, considering January barometer, January effect, first 2 weeks, why be in a big hurry? The commodities trade always goes, you buy your unleaded the middle of February, not the middle of January, the middle of February. And you made money 9 out of the past 10 years. So why would this commodity be any different? I mean, they all basically are the same. This is why I said in that public video today, what we really should be expecting here. And this surprised me. I think I showed this in the video. Yes, or maybe it was on the weekend. I can't remember. But if we look at the first 2 weeks study, so October 3rd, through say the 14th or something, October 3rd, there's the 14th. So interesting that the fund managers still thought that we were at the sort of top of the economy, but you see that they kind of were leaning towards, hey, there's a bit of outperformance here. But interesting how utilities were big on the outs, but real estate and discretionary awful. So this is definitely where we're not in the economy. So, energy's outperforming market top, then sort of market top. I would have thought that we were more over here. This feels like it based on that data. But if that's not the case and we're still over here, and the data itself validates that we're still in this full recovery phase, maybe even here, market top, then that means there's got to be more Fed rate increases coming ahead of us. So that's what the fund managers thought was going to happen. Now, what actually happened? So let's see what actually happened through the quarter. So survey says, oh, now that's interesting. You see how the skew now is actually on the other side of energy. We've got materials here outperforming these guys, and industrials. Why the hell are industrials doing so well? That's all like this area over here, which means that's sort of like here. Isn't that interesting? Can you see how the market itself, the actual data, the fund managers thought we were more like over here, but the data itself is telling us that we're sort of more over here. And if anything, you can't blame the fund managers. I mean, they generally were thinking in the right direction. And how is tech and, Tesla stocks in here, consumer discretionary, how's that doing? Just horribly. Interesting how real estate didn't do as badly as anticipated, nor did the utilities. Some fund manager had to get the hell out of a utility stock, I guess. But interesting how really we're more like here. I think I'm going to say full quarter data supports notion we are at market top. If you listen to the public says that we're in full recession. It's the end of the world. That's not what the data is saying. That is actually completely contradictory to that.